You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. This week we're going to step away from our normal format to explain some investing tools that many times get overlooked, misunderstood, sometimes not even considered at all when people consider to invest their money. And hopefully we'll also be able to draw a correlation between the importance of those tools and maybe how they might apply for you specifically in your investing plan. Joining me now once again is our editor-at-large, Steve Reitmeister. And Steve, we're going to just start from what we perceive to be the beginning when it comes to these tools, and that is earnings reports. Now, earnings reports have really been a major focus for a long time when it comes to investing. They probably have taken on a little bit greater importance since 2008 when the economy turned down a little bit. But why are earnings so important to the investing process?
You know, the investment media is so filled with, just information overload about all the things we should be paying attention to as investors that we have to remember that when we are buying shares in a company, we're buying an ownership stake in that firm. And so we've become owners. And when you're the owner of a firm, whether that be a hot dog stand or IBM, we're interested in the stream of earnings we're going to get as an investor. That's why, as you're saying, that the earnings season is so important. And in fact, very few things move a stock as much as an earnings report will, because it tells us what the company is producing and what it's likely to produce in the future, that stream of earnings that we as investors want to get our hands on.
When we hear about earnings being reported, we also hear about something called earnings estimate revisions. What exactly are those? Yeah.
Well, first you got to start with the concept of what is just an earnings estimate, and then the revision becomes quite simple. So whenever we hear an earnings report and we say the company came in at 60 cents, but 57 cents was expected. So that expected earnings, those are earnings estimates coming from brokerage analysts. Okay, so they review the stocks, they take a look at what's going on with their business model, and they make predictions about what that company is going to produce as far as earnings in the future. So as I said, let's say we have a company that had an estimate of 57 cents. That's made up of estimates from a bunch of different brokers. So a company like IBM probably has 20, 30 brokers that are following it. You add up all their estimates, divide up by the number of brokers. That creates the average estimate or the consensus estimate for the stock. And then an estimate revision is that if people were expecting 57 cents and then say, you know what, business is really good, and they raise it up to 62 cents or 65 cents, that is a positive estimate revision, which is very good. And if they say, oh, business doesn't look so hot right now, and they revise it down to 53 cents, 50 cents, down from that 57, it's like, okay, that's a negative revision. Probably prospects of the company are not as good. I might want to stay away from that stock.
So is the growth rate, the earnings growth rate, more important than the revision?
Absolutely not. In fact, it's one of the great fallacies of investing. People have this idea, if they just get on board the stocks with the highest earnings growth rates, that they'll make the most money. Now, certainly, those are the stocks that are kind of the most appealing. They wow, look how much profit is growing year over year. Boy, this is going to be the next Google, right. the next Starbucks or whatever. Sure. And at first, yes, those stocks will go up a great deal. But what happens is it's very hard to maintain that incredible growth rate. So even if a stock, if they're expected to grow earnings by 30%, and that year-over-year growth comes down to just 25%, hey, growing 25% is terrific, but not if you were expected to grow 30%. And investors will start moving away from the stock because the prospects are not as good as expected.
Quickly, can investors invest strictly based on earnings, or is that not advised?
It's the strongest element, but I kind of liken it to in a bakery. Flour is in almost all the recipes in a bakery, but you got to add other things to make it tasty, to give it the right texture. Same thing with investing in stocks. Earnings is the great core element, but you can add in other things such as valuation metrics or charts or other things that make it just right for your investing style.
How do you prefer to look at earnings? Quarterly? year over year?
Year over year. Quarterly, there's too much noise that can happen. Companies have seasonality. They have different product launches and things of that nature. So taking a look at a year over year analysis is much healthier in terms of the growth rate. You're going to look at that. But here again, I advise you pay more attention to what's happening with the estimates picture.
So you really think that everyone should be looking at earnings on some level?
Oh, absolutely. And I know there's some hardcore chartists out there who's saying that fundamentals don't matter, it's the movement of the crowd. But hey, what moves the crowd is the fundamentals, is that earnings picture. That's where it all starts. That is the cause and effect.
All right, earnings. It is a part of investing 101, if you will, something that everybody should consider. And we thank Steve for taking the time to explain that to us. Still ahead, screening for stocks. How's that important? What's that even all about? We'll tackle it next. Stay with us. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. This week, instead of talking about a particular stock screen with particular parameters, we're calling upon our resident market technician and top stock screener, Kevin Matris, to come on in and give us a little bit of an overview of what stock screening and backtesting is and what importance it may carry in your investing strategy. Let me just start right at the beginning. Why is screening and backtesting so important?
Well, first off, let me just say, usually in these Screen of the Week segments, I normally outline either a unique way to screen for stocks or I'll go over a proven, profitable trading strategy. But yeah, in this week's segment, I kind of wanted to start at square one and go over why screening and backtesting is so important. But also, too, I believe that it really is step one in being able to become a better trader and investor, and that's what we're going to be talking about today.
All right, so why should someone use a screener to pick their stocks? Why should I or anyone use a stock screening method or tool?
Well, first off, the short answer is because there's over 10,000 stocks out there, and we all need a way to find the good ones. The long answer is, other than buying stocks that are talked about on TV or written about in the newspaper, touted on the internet, not to mention tips from a friend, how else are you going to be able to find certain stocks that meet certain types of characteristics. And even if you don't use a screener right now per se, people still kind of do their own screening in one way or another. They may hear that a stock has a certain growth rate or PE ratio or sales surprise, whatever. Then they find themselves listening for or reading about or surfing the internet for stocks that meet this kind of criteria. Well, the whole idea is that if you're trying to find stocks that meet certain kinds of characteristics, certain kinds of fundamental criteria, you can do so quickly and easily with a stock screener. But just because you narrow down 10,000 stocks down to only a handful doesn't necessarily mean that you've picked the best stocks on the planet. You might have picked the worst ones, but how will you know?
And let me guess, that's where the back testing part of it comes in.
Very true. That is where back testing comes in, and it's very important because once you've created a screen, you can then back test it to see how good or bad your screening strategy has performed. In other words, does your screen generally pick stocks that go up once they've been identified, or does your screen generally pick stocks that get buried once they've been identified? This is very good stuff to know. And with back testing, you can see how good your strategy has performed in the past, so you'll have a better idea as to how it will perform now and in the future. Now, of course, past performance is not a guarantee of future results, but what else do you have to go by? So think about it. If you had a strategy that did nothing but lose money year after year, trade after trade, over and over again.
It'd be broke.
Yeah, there's no way you're going to want to use that stock picking strategy. Why? Because it has proven to be an unprofitable strategy. It's proven to pick bad stocks. Sure, it may start picking winners all of a sudden, but it will probably continue to pick losers the way it always has in the past. On the other hand, let's say that you have a strategy that has done great year after year, trade after trade, over and over again. Of course you're going to want to use that strategy. Why? Because it has proven to pick good stocks. And while that may start picking losers all of a sudden, now that you're using it, right?
Yes, right.
It may also continue to pick winners the way it always has over and over before. Now again, just because you have a winning strategy, that doesn't mean it's going to preclude you from ever having another losing trade. On the contrary, even the best trading strategies only have 65 or 75 or maybe even an 80% win ratio. But if you have a strategy and if you have a screen that picks winners far more often than losers, once you find yourself in a losing trade, you can cut your losses quickly and you can feel confident that you'll be able to find a winning stock to replace it the next time around.
And that's important to know.
It really is. You know, a lot of people, you know, they really don't know how to pick better stocks. They don't know, you know, if their strategy is going to produce the kind of results they're truly looking for. And it's interesting because it kind of reminds me of a conversation I had with somebody a long, long time ago. But this guy, he was stuck in a losing trade. And I remember I asked him, I said, why are you still in that stock going down that keeps on losing you money? He said he didn't think it was going to go much lower from here. Fair enough. So I asked him, I said, did you think it was going to go this low when you first bought it? He said, no. I said, do you think it's going to go up from here? He said, maybe not right away. He said, it still could go lower before it finally turns around. And I said, there are so many stocks that are going up. Why don't you get out of that one that's losing you money and get into a better one? Mm-hmm. He said he didn't know of any better stocks to get into. I says, what if you did know of a better stock to get into? Would you do it? He said, sure, but he says he didn't know how to find better stocks. And it was that last comment that said it all. He was in losing stocks because he didn't know how to pick better ones. But again, if he had a proven, profitable stock picking strategy, he could, and he would have the confidence that the next stock that he did pick would have a high probability of success.
That also sounds like one of the reasons why people stay in those losing stocks too long.
It is, you know, like I said before, I think people stay in these losers too long, or they keep themselves from picking new stocks because they just don't have any confidence in their stock picking ability. So I believe that when you're trying to become a better trader, trader and investor, and when you're trying to figure out how to improve your results, you need to stick with a stock screener. Also, too, you need to be able to determine what kind of trader and investor you are. The reason why this is important is because if you find yourself trading a strategy that is not in alignment with who you believe you are as a trader, you're going to abandon that strategy the very moment it hits a rough patch. So it's very important that you create a screen that is in alignment with who you believe you are as a trader. Make sure that the backtesting results are also in alignment. It has the risk to reward profile that is in agreement with you. And once you have that part taken care of, you're going to find trading to be more fun, and you're going to find trading to be a lot more profitable.
We're going to get into that a little bit more at the roundtable coming up here a little bit later in the show. We call it Investor Know Thyself.
Nice.
Know what kind of a trader you actually are. Quickly, screening is something that is approachable. Most people can do this?
It actually is quite easy. Some people think that this is some, rocket science thing or some esoteric thing, but, there's so many screeners out there. We have screeners, of course, at our company, but there are free screeners out there pretty much everywhere. They're very easy. If you sat down and you just spent maybe even 5 or 10 minutes on it, you're going to find that it's probably one of the most powerful tools any investor can use to supercharge their screen.
Short answer is yes. We'll be back with more. Stay with us. Still to come, explaining the 4 main investing styles at the roundtable. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Did you know there are 4 main styles of investing? Have you thought about which one is best suited for you? If you did know that, well, hopefully we can shed some light in this conversation with our editor-at-large, Steve Reitmeister, that able-bodied resident research director, Shiraz Mian, and we welcome back that market technician that we talk about all the time here, Kevin Matris, who we talk about all the time, I guess.
Behind his back.
Yeah.
Right.
Steve, let's start with you.
Okay.
Value investing.
Okay.
Core principles, please.
Yeah, all investors want to say themselves they're value investors because they're trying to buy something they think is worth more money that it's trading for today. But the true value investors are trying to take a look at relative metrics that would try and prove to them that this stock is trading for less. Core metrics like the PE ratio, price to earnings, or whether that's book value, or some other concept that says, if you take a look at the balance sheet or the cash flows or the earnings of this company versus its peers, that it's trading at a discount towards the others, and that's the attractive element. So to try and buy them when those relative ratios look favorable, and hopefully other investors agree and start to buy it up. And so that's a value investor, very much of a contrarian style, and saying the rest of the crowd is wrong, and in time, hopefully, they prove to be right.
All right, Shiraz, another thing investors like to invest for is growth in income. What type of investor fits that profile?
Well, the primary motivation for growth and income investing is to ensure for yourself a steady and predictable income stream now in the present day. And the way you ensure that income stream is by buying stocks that pay dividends. Now, the way the growth and income style ensures that you get a company that not only pays dividend but has good prospects of growing that dividend in the future. Is the way that ensures that income stream. So you look for companies that not only just pay dividend, but also have above average attributes on a number of metrics. So this company is the leader or one of the leading companies in its industry. It has above average earnings growth in its industry. It has a solid balance sheet. It has a track record of consistently paying dividend and has a credible management team. So not every company that pays a dividend qualifies for a growth and income style of investing.
Okay, so the growth comes from two different directions, from appreciation in the stock price as well as from dividend.
Yeah, the focus from a growth and income perspective is that it's a dividend paying stock which provides you this income stream, and that income stream is expected to grow in the future because it's an above average quality company.
Okay, Kevin, the momentum style of investing, does that have some kind of a technical bent to it that we should know about?
It can, but you've got price momentum and you've got earnings momentum. But usually these two things kind of go together. So a momentum investor is looking to take advantage of either upward trends or downward trends in a stock's price momentum or earnings momentum. And the idea is that they believe that prices will continue in the same direction based on the momentum that is already behind it. So if you're looking at these kinds of companies, oftentimes you'll see companies that have gone higher day after day, week after week, maybe even several months in a row. Also, too, these kinds of companies will oftentimes be making new 52-week highs. But that's a good thing because evidence has shown that stocks making new highs have a tendency of making even higher highs. Now, from a technical perspective, these stocks are very easy to find on a chart because oftentimes you'll see these stocks really in nice, solid uptrends. Normally, they are trading above their shorter-term moving averages and, of course, their longer-term moving averages. When you're looking at earnings momentum, though, that's the same thing. Not only are you looking at companies that are putting up better numbers period after period, but you're also looking at the rate of the growth accelerating as well. So when you're looking at earnings growth, the acceleration is really what is attracting a lot of investor demand. And that is why I believe price momentum and earnings momentum go together, because there has to be some kind of catalyst to continuously push prices higher and higher. And I can think of no better catalyst than to see accelerated earnings growth to send prices continuing to trend up.
Okay. Finally, aggressive growth.
Yeah. This is the one that I think most people want to put themselves in because it's always more attractive to go for stocks that are having phenomenal growth rates. So in general, we're talking about stocks whose year-over-year earnings growth is about 20% or greater. The downside of this approach is that it's really terrific when the companies are in the early parts of their growth cycle and the stocks just bang out. When you say if you were an early investor in Starbucks or Apple or Google and things of that nature. But at some point, it's very hard for them to keep up that earnings growth rate, okay? And even if it's just trimming down and say, well, we're not going to grow by 30% a year, but we're going to grow by 25% a year. 25% a year growth is terrific, but not if the world was expecting you to grow at 30%. And so now all that premium and extra PE that was put into the stock is going to be deflated out, and the stock is going to come down. Take a look how Microsoft has basically gone nowhere for 5-7 years, and you'll understand what I'm talking about.
So how does somebody know what style best suits them?
Yeah, I mean, listen to what we're saying here. It's just like, which one of these seems to naturally suit my style? You know, when you're sitting there listening to it, which just seems to fit on me well. And then what you try and do is you try and invest in that style. And it's like, is this the natural place for me? Okay, and it's kind of like that thing, know thyself. Okay, and the better they can do that, the more success they'll have.
Okay, so obviously you have found out here by this conversation that there is more than one pathway to success. What you have to do is what Steve just said. Know yourself well enough to know which investing style suits you best based on risk parameters, time horizon, and other key elements that you want to build into your investing plan. Thanks for joining us this week on Profit from the Pros. Hopefully we've been able to shed some light for you in our different segments on some of the basic tools that you should be considering when putting an investing plan together. We'll see you next time.